In this video, I'm going to be introducing the idea of financial statement analysis and cover a few ratios. The current ratio and the profit margin are discussed at the end of Chapter 3 in your text. Return on assets is at the end of Chapter 1, and the debt ratio is at the end of Chapter 2. So financial statement analysis refers to the techniques that investors and other financial statement users use to analyze financial statements to make informed decisions. Generally speaking, the financial statement analysis techniques illustrated in your textbook are ratios which compare different financial statement elements. So we're going to be calculating some of those ratios, but a ratio by itself doesn't really tell you a whole lot. You really need to have something to compare it to in order to evaluate the company's performance. So three things that we can look at. We can look at a historical trend for the company. So we can say, look at their ratio for the last 5 years. We can do an industry comparison. There are companies out there which compile the information by industry. You look it up by standard industry code, which is abbreviated SIC, or you could benchmark yourself against a specific competitor. So there are 4 basic categories of financial statement ratios. We're going to be focusing on liquidity, solvency, and profitability. We're going to be using the classified balance sheet that was illustrated at the end of the last video. In addition to balance sheet information, we're going to need some income statement information to be able to calculate these ratios. So you'll note here that we're going to assume that Crested Butte General Store had net sales of $10,000 and net income of $2,800 for the year 2024. The first ratio we're going to look at is a liquidity ratio. So we mentioned this term liquidity in the last video lecture, and we said that current assets are listed in order of liquidity on the balance sheet, or how easily they can be converted to cash. So we're using liquidity in a similar but not identical way here. Liquidity ratios measure a company's ability to pay its debts as they mature. So what we're going to be looking at is the relationship between current assets and current liabilities, because we assume that current liabilities are going to be paid out of current assets. So the current ratio is calculated by dividing current assets by current liabilities. So if we pull the numbers off of Crested Butte's classified balance sheet, they had total current assets of $16,700. They had total current liabilities of $10,000. So their current ratio is 1.67 to 1. So there are 2 ways to express this. You can say 1.67 to 1, or you can say that Crested Butte General Store has 1.67 times as many current assets as current liabilities. So is that good or bad? So for the most part, you cannot look at one of these ratios and say whether it's good or bad. The current ratio is an exception to that, because if you have a ratio that's less of 1 to 1, it means you do not have enough current assets on hand to satisfy your current liabilities. So with a ratio of 1.67 to 1, Crested Butte does have enough current assets to satisfy its current liabilities. For a specific competitor comparison, not that our general store is a competitor of Costco's, but they're both retail, selling a wide variety of goods. So Costco's current ratios for the last 3 years have ranged between 0.99 and 1.01. So Costco's staying right there at the 1.1 mark. And you don't want your current ratio to be too high, because that could mean that you have a lot of cash or supplies or inventory just sitting on your books, which makes your current ratio look high, but it's not going to be good for your overall profitability or your return on assets. So speaking of return on assets and profitability, the next two ratios we're going to look at are going to be profitability ratios, which measure a company's performance during a period. So the return on assets is computed by dividing net income by total assets, and the profit margin is computed by dividing net income by net sales. So both of these ratios are expressed as a percentage. So return on assets, which is abbreviated ROA, net income divided by total assets. If we plug in the number for Crested Butte, the net income number you were given was $2,800. The total assets off the classified balance sheet were $28,000. So we have a 10% ROA. For a comparison, we can look at Nike's ROA for the past 3 years, which has varied pretty widely between 8% and 9%. So Crested Butte's is on the low end of that, but they're still ahead of Nike's lowest, so that shouldn't be a bad thing. Next, we've got a computation of the company's profit margin, and here we're going to take net income and divide it by net sales. And so we're going to take the net income of $2,800 again, and the net sales number that's given to you is $10,000. So that is 2.8%. But here's another way to think about a profit margin. Essentially, for every dollar of sales revenue that the company is generating, they're keeping 2.8 cents in net income. So once again, is that good or bad? We need something to compare it to. And here we have Target's profit margin quarterly for the last year or so. And you can see that it has gone steadily downhill from 6% or 6 cents per dollar of sales revenue to 0.7. So 0.7, less than a penny of net income from each dollar of sales revenue. Last, we're going to look at solvency ratios, and this is the ability of the company to survive in the long run, and in large part that depends on their capital structure. So recall the idea that assets equal liabilities plus equity, and a company can either finance with liabilities or debt, or they can finance with equity. So the capital structure refers to the relative amounts of debt and equity the company is using to finance with. So we're going to calculate that by using a debt ratio, which takes total liabilities and divides that by total assets. Debt financing is considered to be more risky. If you borrow money to finance your business, you have to make interest payments and you have to pay back the principal amount. So if cash flows don't materialize like you anticipate, you could get in trouble. So debt financing is considered to be more risky, and a company with a higher debt ratio is said to be more highly leveraged. So we can pull the total liabilities and total assets number off of our classified balance sheet. Total liabilities were $22,000, total assets were $50,000, so we have a debt ratio of 44%. So once again, this ratio is expressed as a percentage. For comparison, we can look at Costco's debt ratios for the last 3 years, which ranged between 66 and 70%. So we can say that Costco is more highly leveraged.